Welcome to the Property Profits Podcast. Thank you so much for jumping on today. So let's get to it. That way you get as much value for your time as possible. Today, I wanted to talk about different types of loans. You might know this, you might not, but it's always a good refresher to see what kind of money's out there, how you can get it for real estate, how you can leverage different types of programs. So let's start off with hard money. All right, you hear this term a lot with flippers, investors, stuff like that. What is hard money? There are hard money companies out there. We actually use several, but one we use, I think it's quick lending on some projects. We have a lot of private money, luckily, but say we need it right away. What that is they're going to charge you a couple points. A point is a percent of the loan amount. They're probably going to charge you like 20% down. Don't quote me, it's somewhere around that. And 80% LTV is usually what they do because they want you to have skin in the game. Usually, when you're getting hard money, you need it to do a flip. They want you to put skin in the game. So let's just do an easy example, right? If you need 100 G's plus rehab, it's 200 G's, right? Total for the project. They're going to want you to put usually like 20% down. So 20% of two, I don't know, you're going to have to put like 40 G's down. Don't quote me on the math. I don't have a calculator, whatever, but you're going to have to put that down plus the whatever closing costs and points and all that stuff. They can get expensive up front, so you need to have some funds unless you have a bridge lender. You can get a bridge lender. What that means is they will cover that down payment and all of that for another fee or more interest or whatever. So the deal's not done without that. There's always ways to do it. But when you're getting into these, make sure you're getting a hell of a deal. Don't fudge your numbers. Don't overestimate ARV. ARV equals after repair value, or don't overestimate what it could sell for on the market. Here's another tip. I always want an exit strategy. What could I sell this project for today? Say that whatever reason, bank funding went out, private money, whatever, what could I just buy it and resell it for? Right? If I had to do it, you need to look through that lens. You need to have exit strategies. Crap happens. Nobody likes crap to happen, but sometimes it does. Always have an exit strategy at different parts of your projects. Shoot for the moon, right? But be realistic about it. And when I say realistic, I'm not trying to crush your hopes and dreams, but just do the math. Make sure the math works. When you're doing your comps, don't take all the highest comp. All right. I know it's sexy, it's awesome until it isn't. All right. Take some low comps, see what could go wrong. Actually look at it through the lens of how could I lose money on this deal? Not in a pessimistic way, but how, if this thing, something went wrong, what would force me to lose money on it? That way you can kind of mitigate some things from happening. So hard money, right? There's companies out there. I gave you one, it's quick lending. There's a lot. You can Google hard money near you. If the deal's good enough and you got the down payment or the bridge lender to bridge you on that down payment, you can get a hard money loan. Easy breezy, right? There's private money, friends, family, whatever, right? Just people. You say, hey, Bob, I've got this project coming up. I'll give you 10% interest, 2 points, whatever amortization they want. Give me a 30-year AM. You can even do a, well, that's really going to be for like if you're going to hold it after. But like I have a private money guy. He'll do 2 points, 10% interest, and 5-year optional lender balloon. So like I used to do a lot of projects to where I would fix them up and ARV would be a lot higher. But rent rates made sense because I wanted to buy and hold and build a portfolio. So I was cool with him doing a 30-year amortization, which he now does a 40-year amortization, which is really enticing because he wants me to buy more. But I'm more focused on multifamily. But here, back to this. Private money is just like friends or family. Y'all negotiate what you can do. Like I said, 10%, 2 point. That's pretty standard. I would do interest only if you're doing a quick flip. Look at your outcome. What do you want? Do you want a quick flip? Do you want a rental? What do you want it to be? If it's a rental, maybe make the payment advantageous to where you can still cash flow a lot after. Private money, there's no rules, right? Like, hey, fund everything, right? You get 100% loans. So that's a good option. Here's another one, FHA. FHA is a government-backed program and protects the lender with mortgage insurance, right? The only bad thing is when you get this loan, you got to pay mortgage insurance also, but you can have a lower credit score. I think you can have in like, I think it was like the high fives. It changes all the time, their requirements, and put like maybe 3.5% down. And the cool thing is they allow up to a certain amount of concessions for closing costs and all that stuff, which is pretty cool. So if you have like a lower credit score, you want a lower barrier to entry to get into a home, I I mean, it's not a bad option, right? 3.5% down. You just got to really do your diligence because you're going to pay a little extra insurance each month. That way, it protects the lender in case you were to default. They look at you of like maybe a little more of a risk. Not a bad thing, but if you get an FHA loan, they're usually pretty cheap to get in. Conventional is another one. So conventional, you hear a lot. It's not backed by the government. But if you don't put 20% down, you got to pay insurance anyways, monthly. But they have programs that are conventional that are like 3% down now, too, if I'm not mistaken. So conventional is not a bad way to go. Here's the difference between conventional and FHA. FHA has a lot of red tape because they're backed by the government, right? They just have a long checklist whenever you go to get them inspected. And if you ever hear, man, will it pass FHA? It's because like you got a property you need to flip, unless it's a 203K, which 203K, they'll actually give you the money for rehab and stuff like that. But if it's like a retail deal and you're not looking into a 203K, which is an FHA program for remodeling a home, but it's just a straight up FHA, man, you're going to play hell passing inspection. Not saying you won't, but it's going to be a little tough. So I always like to ask, if this FHA thing doesn't go right, would we be able to do a conventional? Like, is this lender cool, like switching over to conventional, meaning you might have a little higher of a credit score or some sort of exception, things like that. So that's the difference between FHA and conventional. Seller financing, right? We all know that. Seller holds a note. Seller lets you pay in payments. How about that? I like that's easier because there's different ways to do that. So seller financing, seller has to own the property outright. The seller finance it to you, unless you do a hybrid, but we'll get to that in a minute. So if you're going to get a seller finance deal, hey Bob, I know you own this house for 200,000. It's free and clear. I see I could rent it for like 2,000 a month. How about I pay you 1,000 a month? Oh, cool, Travis. That'd be pretty cool. Like it's just sitting there. I'll take it. All right. Well, then you get into these things like, well, how long are you gonna pay me 1,000 a month? It's like, well, how long will you do it for? The minimum we like to do notes. Usually we've done 48 month, but usually 60 month is like our cutoff minimum because the longer the better, right? We don't mention interest, we don't mention down payment unless they ask, and then we move our numbers around to get to where we're all happy. But that's seller financing. Subject to financing is, say that Bob had 100,000 mortgage on his $200,000 home, but he's still, well, that's hybrid. So look, say it's subject to. He's got $190,000 mortgage and he's cool with you just taking it over, right? Subject to the existing mortgage. So 3% interest rate, you think you can cash flow it. Hey, Bob, how about this? I got a good idea. You had to move across the country. You're tired of paying these payments. How about I just take them over? Mortgage is going to stay in your name, right? I'm going to take title, but mortgage is going to stay in your name. Well, Travis, how the hell am I going to know that you're paying my mortgage? Address that before they ask if you can, but if not, we use a third-party servicer, right? There's third-party servicers out there that will service these and they will alert people whenever payments are made. All right. So in the event that we quit paying, you would know ahead of time because you get the alerts. But say we just stop paying, you take it back, right? You just take it back, right? If you're in Texas, right? Everybody has their own different laws, different states, stuff like that. Yeah, so cool. We went over hard money, private money, FHA, seller financing, subject to. All right, here's another one, hybrid, right? Say that Bob was like, hey, I want 200,000, I have $100,000 mortgage. How are you gonna give me the other 100? You're gonna just give it to me in cash, duffel bag, what? Well, how about this? Why don't I pay you your payments over time, your equity over time? Do you need it all right now anyway? Probably not. All right, cool. So why don't we take over subject to your existing mortgage? We buy it subject to the existing mortgage, 100K out of the equation. All right, there's 100K left. You need that paid. All right, let's come up with a payment that makes sense for us to pay that on top of your mortgage. We still got a cash flow usually, unless you don't like to do that, but that's how we structure these things. So that's more of a hybrid deal. That's a subject to and a seller finance. There's also other strategies like lease options, right? You can lease a property and apply a certain amount of the rents you receive to the owner so that they're happy. We're actually buying a deal, mobile home park that way right now. It's pretty cool. Like the reason the situation fit for us and them is it's kind of in a small town, but town's growing. We have hopes for it. We did like a 2-year lease option, we're doing a 2-year lease option. We haven't fully executed this thing, but I'll give you the rundown. And we're going to add some units to the park and increase value. So that's kind of our down payment, right? They're tired of managing it. Great people. We hit it off really well. I think we can improve the park. I think we could get them the evaluation they want because as is, we can't pay them the valuation they want. So if we lease it and pay their mortgage and bills and we make profit after, we can build the park up and get it over the valuation they want, refi them out in a couple years. Pretty badass deal. But these are just some options and different loans and things like that you need to know about. There's obviously a lot more. There's VA loans, right? Whenever somebody's a veteran, they get some badass perks. And people always want to know, like, are these assumable or what loans are assumable and all that. Generally, FHA loans are assumable. Conventional loans usually aren't. But like I said, you could do subject to also just a little riskier because they got a lender and people get scared about the due on sale clause, but it's just part of it, right? I mean, I don't know. I'm not a lawyer, I'm not an attorney, so I'll be careful when I talk about that kind of stuff, but I like the heck out of creative stuff. I think it's badass. But VA loans, I don't think that they have to put anything down, right? They get good interest rates. Those are assumable also. I'm not a VA loan expert by any means, so correct me if I'm a little off here, but VA loans are assumable if you're veteran to veteran assuming, then they have a certain entitlement. They can go to their next house, they get to keep that. But if it's not a veteran to another veteran, they lose some of that entitlement. Pretty cool stuff how they do all that. But there is very creative ways to do this. And man, there's a lot of loans out there. There's more than I even mentioned here, but I want you to have this in your vocabulary and this arsenal that you have these tools, at least you have this knowledge, right? If you didn't get everything that you needed out of this podcast, because it's a quick podcast, you drink out of a fire hose when you jump on this thing, right? If you didn't get everything, I encourage you to dive a little deeper, go to Google University, get your mind wrapped around it because you're not going to just understand it right now. And start to understand what types of money there is for these homes, what types of loans you could get, what times how you can help people with knowing these things and do more deals, do better deals. So thank you for jumping on today. Appreciate the hell out of you, and I can't wait to see you on the next one.